In today's episode of Stock Due Diligence, we'll be covering the basic financial analysis that you must perform prior to investing in a company. How's it going, guys? Ryan here and welcome back to another episode of the Stock Due Diligence series, and today we're covering the financial aspect of due diligence that is required prior to investing in a company. But before we get into that, guys, if you do enjoy today's video, please give it a thumbs up. It helps me out so much, and subscribe for more investing, stock market, wealth management and cryptocurrency content. I'd also love to know some of your favorite financial analysis techniques down in the comments section below prior to investing in a company. So without further ado, let's get straight into today's episode. So presuming that you've finished episode 1 and you've shortlisted the companies that you're interested in looking at, the next stage that you want to perform is that financial analysis. Now, what is the purpose of financial analysis? Well, effectively what we're trying to determine is the current financial position or state of that organization. We want to know if they're performing well, performing relatively middle ground, or if they are in dire straits and potentially going bankrupt. You can have all these different scenarios across the board, across every single industry, and it's important that you don't invest in an organization which is struggling if it has no hopes of recovering. What our key aim here to do is invest in successful companies, and as a result, the finances play a huge role in the organization's success and overall profitability. Before we get into the nitty-gritty, I just want to let you know that we are only reviewing the absolute key information that you need to look up and need to research. And effectively that means if you already know how to perform a extensive financial analysis, this video probably is not for you. This is really to cover off the basics for people who have no idea where to start when it comes to looking at the finances of an organization that they wish to invest in. So make sure you keep that in the back of your mind when looking at this video, as there are a lot more advanced techniques and equations and all that sort of really cool and techie stuff that you can use to make more informed decisions should you have the desire. There are 6 key factors you need to consider when you're performing your first financial analysis of an organization. The first of which is the company's revenue, and simply what the revenue is the amount of money that is coming into the organization. Do not mix this up with the company's profitability, because in order to understand the profit, we need to take in a lot of other considerations to account. So the revenue is purely the cash flow, what is coming into the company, whether that be through sales, whether that be through interest on loans, whether that be through other investments, how much money is coming into the organization. The second factor we want to consider is the expenses. So this is the opposite. This is the outgoings of the organization. Do they have really high admin expenses? Is the processing equipment that they use on their facility particularly unsuccessful in its efficiency, and as a result costs a lot of money in order to process whatever material that company is manufacturing? These are some of the things you'll have to consider with the expenses, but effectively it is all the outgoing costs of the organization. The third point you want to consider is the company's cash position. And when we're talking cash position, we are talking the amount of money sitting in the company's bank account. This could have come about from profit, this could have come about from loans, this could have come about from capital raises, but effectively it's the amount of money they have sitting there to use right now for their current or future operations. The fourth consideration is the debt position, which is the opposite once again. How much money does the organization owe? And this is typically in the form of loans to banks or lenders, and effectively you need to consider not only the amount of debt but the interest rate and payments on that debt which need to occur. The fifth area to look at is the assets. So what does the organization own and what do they have stakes in? So for example, they may have a factory which they own 50-50 with another JV partner. They may have tenements which are mining and producing. They may have laboratory facilities depending on the organization. They may have vehicles. All these sort of things are counted as assets. They even may hold other organizations which would be considered as assets as well. The sixth and final area we're going to be looking at today is the liabilities. So what is owed? It is the opposite to the assets. Now, obviously these can be things like debt, but they could also owe other things as well. So we'll get a bit more into that later in the video. In order to illustrate all these key points, I'll be using FMG, also known as Fortescue Metals Group's half-yearly financial report to show you real-world examples of what you need to look for when choosing an organization. Let's first take a look at the revenue and the expenses that are incurred by organizations. So looking at the revenue, these are all the cash inflows that are coming into the organization. And what you're looking for is typically what the sales are or what the subscription fees are or what is it that is generating this organization funds before you invest in the company. So for example, if they are a mining company, they're likely going to be selling ore to their customers. If they are a software company, they may be subscribing to various licensing services and their customers will be obviously paying a regular fee for that, or they may just sell software packages outright. A biomedical company may be manufacturing drugs and selling those to pharmacies or the general market. These are effectively revenue inflows. You can really get into depth and see that you can get interest of lending money and that sort of thing as well, and these would be additional cash flows. But the key is to understand the amount of money that is coming in as a result of their primary sales driver or service driver or whatever it is, their main form of making money. Next, you want to look at the expenses, and these are the outgoings. So for instance, if you have that mining company which is producing ore to sell to their customers, what is the cost of production? Furthermore, what are the additional overhead costs that are associated, such as administrative costs? There can be many different factors that are taken into consideration here that can take away from the potential profits when it comes to expenses. So the key is to look for companies with low expenses or optimized facilities or production methods that allow them to beat their competition and increase their profit margins. Now let's take a look at FMG to show you these in action. So with FMG, we can see that there are three key methods for obtaining revenue. They have revenue in the form of total iron ore, which is effectively their sales. They have revenue in the form of total shipping revenue, and they also have a stream of other revenue. You can get into the details of these other revenue sections in other parts of the documentation if you desire. But effectively adding these three numbers together gives you the total operating sales revenue, and this is the figure that we are really looking at. And as you can see below, you can see the average prices and that sort of thing as well. The next thing we want to look at is the expenses, and typically these will be for FMG in the form of the production costs for the mining processing of their ore. So as you can see at the top, you have that value. Then you can see there's other associated costs such as rail costs, port costs, and that sort of thing as well. Move down the page slightly more, you can see there's costs associated with shipping, government royalties where the Australian government takes money off them for their goods, Administration expenses, so these are typically your overheads, your staff, your white collar performing the work, for instance. All these things need to be considered when we're taking costs into consideration. To really see the full picture, we will be looking at the EBITDA, which is effectively earnings before interest, taxes, depreciation, and amortization. And as you can see here, we are then taking everything into consideration when it comes to expenses against revenue of the organization, which will effectively give us our net profit after tax. The next two key areas we want to focus on are the cash position and the debt position. As I mentioned previously, the cash position is the amount of money that they have on hand at any one point in time in order to facilitate future projects, current operations, all that sort of thing. And it effectively is what allows a company to operate. As soon as a company does not have cash on hand, that is when they'll need to get a loan. And we move into the debt side of things. So we want to be looking at the amount of money that an organization has borrowed, whether it be from lenders, banks, all that sort of thing. Not only the sum of the amount of debt, but also the interest repayments that are required. But more importantly, how long and what is the plan for paying off that debt? Could the organization pay it off with their current cash position if they wanted to? Do they have enough revenue coming in and profit coming in order to pay that off within the next 6 to 12 months, for example? These are some key considerations that you need to keep in mind when looking at the debt position as well as the cash position. So let's take a look at FMG and see what they've got. Looking at FMG, we can see that they have borrowed some money and they also have some leasing liabilities sitting there. This effectively equates to just over $4 billion worth of debt. But furthermore, they also have roughly $4 billion worth of cash on hand. Now, something to keep in mind is that cash on hand consists of some of those loans. So it doesn't necessarily mean that the organization would just pay it off straight away. It's the same as, for instance, getting a loan for the bank for a personal reason where you take out 10 grand but you haven't yet used it. So don't be fooled. This money may be there in order to do something as opposed to being able to just completely pay off the loan immediately. But what we can see is that they are actually in a negative cash position. So we can see that by the bold, and they are $110 million in the negative at this point in time of the report. Next, we'll be looking at the assets and liabilities section of an organization. The assets is effectively everything that the organization owns. So we're talking anything from facilities to vehicles to inventory to companies. All those sort of things are considered as assets because they're owned, they have a value. Now, these assets may be revenue generating, they may not, but they have an intrinsic value themselves. Opposingly, the company will also have liabilities of some form, and we've covered a few of these already. They may be in the form of a debt, they may be in the form of money owed from tax invoices that has not yet been paid. These are effectively amounts of money that an organization owes to someone else, and at some stage, whether it's now or later on, they're going to have to pay that money back. Can they or can they not? Well, that is really going to be a fundamental factor in your decision when it comes to investing in an organization. Obviously, you don't want to invest in an organization that is unable to pay back their liabilities, as they may need to start selling off some of their assets in order to cover it. So let's take a look at FMG's financial position with regards to assets and liabilities. You can see that this is being laid out in a much more readable manner than potentially some of the other areas as we are now in the consolidated statement area. And as I mentioned before, with the assets, what we're looking for is cash, which we can clearly see they have almost 4 billion on hand. We're looking at receivables, so money that is owed to FMG, which is 988 million USD. The amount of inventory they have on hand, goods they have, that can be literally in the form of ore for FMG that is sitting there in their stockpiles, 953 million US dollars, and they have other current assets as well. So as I mentioned, these might be things such as vehicles. Then we can see non-current assets, and these effectively make up quite a large portion, and we're talking property, plant and equipment, that sort of thing as well. So a literal mine itself would be an asset to consider here. Then we're moving on to the liabilities, and we can see that there are a various suite of liabilities here. We have derivatives, we have provisions, we have borrowings, we have trade and other payables. So we're talking literally invoices that haven't been paid and that sort of thing. Deferred joint venture contributions. So when a company's in a joint venture, let's say it's a 50-50 split, each company has to contribute their portion to it. So that's what that's referring to. Current tax payable. So if they owe tax, they know it's a liability. They owe the tax office that amount. Then we move down, we can see they also have some non-current liabilities as well. Now, the key thing to note here is their net assets is positive. So we're looking at $15 billion positive because the assets significantly outweigh the liabilities. So if worse came to worse, this organization is $15 billion up. So you don't really need to worry. And FMG obviously is a company that pays dividends and grows over time. It's relatively stable. We're not looking at a micro cap stock here. So this is what you'd expect to see. As I mentioned at the start of the video, these are just the absolute basics that you need to consider in order to make a decision on whether to keep looking into an organization to invest or not. You can perform lots of other calculations and do more research on the finances of a company really in depth that will help you make a more informed decision. So you know, price to equity ratios and those sorts of things. And effectively that will help you, but at an absolute minimum, understand the balance sheet, the current cash position, the liabilities, the assets, all these key components that make up any company. And obviously, if you're looking at a large tier 1 company versus your micro cap sort of stocks, they're going to have significantly different positions. One key thing to note is if you're looking at micro cap stocks, they may have large debt which doesn't look like they can pay off due to the fact that they're not bringing in any revenue. They may be a small version of FMG in the sense of an exploration company looking for iron ore, and they've managed to just find a tenement and taken on a loan in order to develop a mine there. These are the sort of situations when you need to start then taking into consideration the future financial state of the company. When are they going to be able to pay back their loan? When are they going to start generating revenue? All these sorts of key factors. But at an absolute basic level, you need to consider these 6 key things before you invest in a company. So I'm going to wrap up today's video there, guys. I hope you did enjoy it, and if you did, please remember to give the video a thumbs up. I'd really appreciate it. And if you're interested in seeing more of this content, more of this series, please consider subscribing to the channel. We talk all things stocks, investing, cryptocurrency, wealth management. I'd love to know as well your thoughts on today's episode down in the comments section below. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.